Welcome back to Radically Rational Radio. First Republic Bank was unable to find a buyer, so the FDIC came in and put them up for auction. And over the weekend, we had one of the largest asset transactions happen. JP Morgan, already one of the largest banks in America, has just now gained all the assets and deposits of First Republic Bank. This is crazy.
JP Morgan taking First Republic. It's a big deal. It's maybe, hopefully, the end of what has been a crisis of confidence in the banking sector. JP Morgan assuming the deposits and assets from the company. I want to get straight over to Leslie Picker, who's been working all weekend. And what a story it's been with so many different bidders. The FDIC in the middle. And, of course, Janet Yellen. Tell us about it.
It's historic. It was a competitive bidding process. This weekend was fast and furious. But, yes, the news this morning is that JP Morgan is acquiring First Republic directly from the FDIC, which seized and immediately sold the faltering bank. This transaction, the result of a competitive bidding process, at least according to the FDIC and JP Morgan, includes a majority of First Republic's assets, including $173 billion in loans and $30 billion in securities. Specific terms for First Republic's underwater assets are not quite known yet. We should learn more about that over the course of the next few hours. But the FDIC and JP Morgan entered a loss share agreement where they'll basically share in the losses and potential recoveries from some of First Republic's single-family, residential, and commercial loans it purchased of the former First Republic Bank. And JP Morgan will assume about $92 billion in deposits. That includes the $30 billion in uninsured deposits that were infused into First Republic by itself and other large banks in March in an effort to prevent any contagion effects from the failures of Silicon Valley Bank and Signature Bank. As part of this transaction, JP Morgan intends to repay the deposits from its large banking peers or eliminate them as part of the consolidation. First Republic will go down as the second largest bank failure in U.S. history. That's bigger than Silicon Valley Bank. In a statement out earlier this morning, JP Morgan Chairman and CEO Jamie Dimon said, quote, "Our government invited us and others to step up, and we did. Our financial strength, capabilities, and business model allowed us to develop a bid to execute the transaction in a way to minimize costs to the Deposit Insurance Fund." That FDIC estimates that the cost of that deposit insurance fund will be about $13 billion as a result of this transaction. JP Morgan will not be assuming First Republic's corporate debt or preferred stock. Shares currently trading just under $2 per share in pre-market, so not quite at zero, but they've gone down about 98% so far this year.
First Republic was the second largest bank failure. The Kobayashi letter sums it up really well. JP Morgan just said its acquisition of First Republic Bank will generate a one-time gain of $2.6 billion. They also expect over $500 million in profit per year from the acquisition. On top of this, the FDIC is covering $13 billion in losses and providing $50 billion in financing. This is all while JP Morgan is technically not allowed to acquire the deposit accepting bank due to regulations. We are witnessing the product of a flawed system. You probably don't know, in acquiring First Republic Bank, JP Morgan has bypassed laws against acquiring banks while controlling 10% plus of U.S. deposits, shared $13 billion in losses with FDIC, received a $50 billion loan from the FDIC, effectively bought back its own deposits, expects profits of $5 billion over the next 5 years, added $18 billion in market cap this morning. This crisis has taught us that the rules don't matter in a panic. And the biggest thing we're showing is that if a bank is going to fail, we're not going to let it fail. But what's most important is don't come in and buy it, because if we do let it fail, the FDIC will come in, save it, and it won't fail. It is clear why no one wanted to buy First Republic until it collapsed. Large banks know that the collapsed bank comes with perks and shared losses by the FDIC. The FDIC needed to help, and JP Morgan is making billions off of it. If the FDIC was willing to make this loan, why didn't they do it to First Republic directly? If this was the answer, why didn't we just give it to the bank? Because our government is only interested in moving assets. How can we keep saying when banks are too large, it ends up being incredibly dangerous? We need a decentralization of banks. And now we've just watched the largest bank. To me, this looks like stakeholder capitalism. We have a bunch of people trying to steal assets and have our government pay for them. Consolidating assets like this only puts the US dollar at a greater risk. I hope you learned something. I'm Tristan. This is Radically Rational Radio. Like, comment, subscribe. I'll see you in the next episode. Stay resilient.